Hello and welcome to my latest weekly video news from Madison. So there was two bits of research that caught my eye this week as being quite interesting in the world of property. And the first one was delivered from Rathbones. So Rathbones, a big investment house, manage people's funds, their wealth, their personal assets, a kind of competitor of who I used to work for when I worked at Coutts. And obviously, when you work in those kind of roles, you want your clients to invest with you and stay vested with you. You want them to be happy with the returns they're getting. And I know that when I did that role from, 2005 to 2012, I was with Coutts. I was with Barclays Wealth before that, so a similar kind of role. One of the biggest contenders I came up against in terms of which asset class to invest in was property versus a fund containing stocks, shares, gilts, cash, hedge funds, those kind of things. Because for many people, the baby boomers especially, and then my generation after that, property was the gift that kept on giving. So if you looked at the returns between those kind of 1990s right through to 2016, property just gave phenomenal returns. Rathbones have declared that was about 6.7% per annum between that period, and that far outperformed any particular asset class. So, of course, a lot of my my clients would be thinking, what should I invest in? Do I invest in a buy-to-let property? Or do I invest in stocks and shares fund with Deborah? And I would really battle against that in the world of property. Well, Rathbones now feel that property is no longer such a solid investment. They say if you invested £100 in 2016 in property outside of London, it would now be worth £134. If you'd invest that £100 in London in property, it would be worth £111. But if you invested it in a fund, sort of 25% UK equities, 75% international, which is quite normal, it would now be worth £174. So basically, those returns within a fund between the period of 2016 to 2024, so those sort of 8 years, have been far better in funds than they have been in property. And that's because property has seen a far more mediocre increase of about 3.7% per annum. And some years that hasn't even kept pace with inflation. Of course, if it is a second property, you'll pay capital gains tax on it. You'll have entry costs of stamp duty. And debt has been traditionally very cheap. That would be one, obviously, argument against that was it was very, very cheap to borrow between 2008 right through to 2022. Money could be borrowed at really, really low rates. So your cost of debt wasn't very high. But they're basically saying that doesn't it make more sense now to invest in a fund? Um, I don't know really. I mean, I suppose buy-to-lets have always had a good relationship. You've got very stable rental yields that do continue to rise, good solid tenant demand, and low interest rates still around that. I still would say that interest rates are very low. And of course, although that's looking at the growth, that's not taking into account your annual yield as well. So you will have annual monthly repayments on that because your tenant will be paying you rent. So typically yields in this area run at about 4%. So let's assume you have no debt to service from that. You have your annual growth of 3.7 from capital gains, and then you'll have your income yield on it running at about 4%. Now, obviously, there's costs in that. You have to pay, hopefully, for a good letting agent to manage it for you. There'll be repairs and things that are needed to property. So that 4% does get eroded. Even if it went down to 2, you're at 5.7%. So I still feel that property is a good place to invest. I think you get really good yields in terms of ongoing payments, and you get that growth as well. There are very few asset classes that will give you both yield and growth outside of property. Traditionally, equities are all about growth with some dividends along the way, but that is often looked into a fund. That's all part of the returns they declare. And if you look at something like bonds, which give a much higher yield, they don't have so much growth. So, yeah, I think thank you, Rathbones, for that. Interesting, but I still think property has its place in a well-diversified portfolio, I have to say. Diversification is the key at all times, never exposed to one thing. That's what I always used to say. The other interesting report that captured my attention was from Winkworths, who have reported a huge uptick in family properties going to market, and the reason for the sale is because of VAT on school fees. So traditionally, those properties have sat outside of really good school catchments, but the owners haven't particularly cared because they're going to roll the private school fee card. But with that going on, that now isn't an option. So either those families are selling up to live in the good catchment areas for the schools, or they are selling up and basically banking some money to live in a cheaper area to then pay for the school fees, recognising they cannot no longer continue to do that where they are at the moment. We're not seeing that so much in Tunbridge Wells at the moment. Tunbridge Wells has always had a great affinity with good schooling because we've got the grammar school system. So it's always been popular to be within catchment of the grammar schools. And of course, we have some super selective grammars as well, where as long as you live within Kent and you do very well in your test, then you'll get a place. So those are a different kind of situation. But interesting to see that that is what Winkworth are feeling and reporting through. I will keep you posted on whether we see that in the market. Well, finally, this is going to be my final vlog for a few weeks because my lovely best friend Holly, who edits these videos for me, is going on holiday. So have a lovely break, Holly. And then I am on holiday at the end of next week. So she'll get back and I'll be off. So I will report back in the first week of August. The biggest question anyone asks me at this time of year is, should I rest my property over the summer? Let's give you a quick roundup on that. You have to basically be off the market for 14 weeks or more for the date to reset in terms of the date that you launched and where you are seen in a search result. But some people just want the break from the viewing. So you're going to be, if you wanted to come off now and set that 14-week timer ticking, you'd need to relist sort of mid-October time, which means you're missing the autumn market. I would say no point. So the only reason really why I feel you take your property off the market at this time of year is just you're simply sick of the viewings and you've got to have the kids at home and don't want to be clearing up all the time. Or if you just feel your property's feeling a bit overexposed and you want to just stop the market seeing it for a little while, then that can be a sensible route. But it will go quiet now over the summer period. When I come back from my holiday, I am around this week and next. When I then get back from my holiday, sort of that midweek, early first week of August, it will be quite quiet. And then we will gear up to the autumn market. So I'll be back then to tell you what's been going on. If in the meantime you're looking for a great family home, I've got two fabulous ones I want to quickly tell you about. This first one on Duncalf Road, this is on the Hollyfields estate. It's on at a guide price of $850,000 and has really spacious accommodation, a lovely landscape garden and a very generous driveway and garage. And that one, of course, St Peter's catchment. They do very well in the Kent test if you're thinking about that schooling sensation. And then this lovely property in Crowborough, 32 The Grove, on at a guide of £745,000. Really spacious, lots of reception rooms, lots of bedrooms, and a really lovely, quiet, no-through road. And of course, great location being walking distance to the town of Crowborough and all that it has to offer. And it's great schooling. So I hope that's of interest. Have a great few weeks. I'll look forward to seeing you when I'm back from my holiday, rested, recharged, and gearing up for that autumn market. Bye-bye.